Good morning, everyone. And I'm Mark Phillips, and I'm here with Harvested Financial to talk about what's going on in the markets. And first off, I want to talk about Plug Power. Whoops. And they've got earnings this week. So Plug Power is the famous hydrogen fuel cell company that is producing all of these fantastic batteries. They're being used in all kinds of really interesting places like Amazon warehouses. They're being used for potentially for vehicles. So they've gotten a lot of tailwinds from the green energy movement that's been coming out. European Union's behind it. U.S. now with the new administration is behind it. So Plug has just been soaring recently. Since their last earnings, stock is up almost twice as much. And so that is why we are going to look at what is going on in Plug Power today. So Plug's got earnings after the close later this week. And we are going to think about how you could possibly use a covered call in an earnings scenario. So I want to look at the markets right now and think about using a simple strategy like a covered call where you're long stock and selling a call against that as a way to protect against an adverse move during earnings. So, like I said, given this major rally, given not only that, but the fact that the straddle currently is trading relatively above the historical norms for a move. Now, granted, those historical norms are based on a slightly lower stock price, but we are seeing elevated implied volatility here. The front month volatility is trading something like 50 points above the back month volatility. So there is some expectancy of move here. And by selling a call, we can capture some of that additional premium and use the funds from that call to offset potential downside risk. So I'm going to go through and I'm going to compare a couple of different covered calls in Plug Power and think about how they might be used to diversify your position going into earnings. Uh, I do have the note here to think about what does open interest show us. And I will pull up my screen share real quick and show you what I'm looking at in terms of the open interest. So to get into some of the different strikes that we're going to analyze, I'm going to analyze the ones that are at the relatively round numbers, and that's because that's where there's the most open interest. So at that 55 level, we see something like 4,000 contracts of open interest, 25 on the put side, just under 15 on the call side. At the 60 level, we see something like just under 5,000 contracts of open interest. And at the 65 level, we see about 6,000, 6,200 contracts of open interest. This is compared to, 1,500, 1,200, maybe 3,000 on some of these lines in between. Part of that's a function of the fact that these strikes have been around for a little bit longer. There's a little bit of round number fallacy. One of those things people like to think about is the round numbers. And so that has created a concentration of positions on these 60, 65, 55, 60, 65 strike lines. We're going to analyze what the different yields and premiums are coming from those different strikes in just a second. But right before that, we'll talk briefly about why that open interest is going to matter. Well, the positioning of the people on the other side of the trade is going to have an effect on the underlying stock. Depending on who is holding these positions, that open interest is going to present somewhat of a wall, somewhat of an attractor for the stock to pin to those numbers. If someone is necessarily short that line, they want the stock to go there, so they're going to be actively hedging to bring the stock to that point. The open interest tends to act as a vortex for where we believe stock can go. It doesn't necessarily always act as an attractor. There are other fundamental factors that are pushing equity prices around, but particularly with names where options represent a significant percentage of the underlying volume, we see these factors be more and more popular. Plug has become a very active, popular name, so that's why we're going to focus on some of these names, some of these strikes that have that highly concentrated open interest. So let's look at what the markets are showing us here. So I have three different covered calls here that we can look at. So like I said, the 55, 60, and 65 level. From a premium comparison perspective, I have both premium and yield here. And from a premium and yield perspective, we'd expect these to go down the further up. The further out of the money the call that you sell, the less premium you're going to take in, and consequently, the less yield that's going to be. These yield numbers are on a weekly basis. So I'm looking at the February 26th options here that expire in only 4 days. And there, if you were to sell the at the money 55 strike call, stock's down a little bit right now, but selling that 55 strike call would net you about $4 or a little over 7% of the current stock price. So that's definitely an interesting proposition to sell those calls and collect that kind of premium right now. Sorry, just over 6%. Um, the At the 60 strike level, we're looking at collecting premium around the $2 level. At the 65, it's down to just a little over $1. Now, you might want to think about how uh, that call that you're going to sell will also benefit your potential gain in the stock. If you sell the 55, you're giving up all the potential gain now. If you sell the 60, you still have a little over $5 for that stock to run. So if you are slightly bullish still, the further out of the money call that you sell, the more interesting that gets. Now, that is going to provide less of a cash offset to your earnings on the other side, to an earnings surprise on the other side. So, the extent that we get a down move, the $4 that you collect on the 55 strike call will protect you theoretically all the way down to around $51. Collecting only $2 gives you slightly less of a downside buffer. So, one of the main things to consider when you're setting covered call strike prices is how much downside buffer do you want, especially going into an earnings trade. So going into an earnings trade, the amount that you collect is going to not only cap your upside, but it's going to provide that buffer to the downside to the extent that we see an adverse move. Overall, covered calls are still going to be a bullish proposition because they're still going to benefit the most, even though you're short that call, from a rise in the stock price. So going up to and even through the short price where the call you've sold, that is still going to be the best result for your position. So even if you sell the 55 call and stock goes to 60, that's still the most winning scenario for you in that case. Now you captured a lot of premium because you're giving up more of that potential upside, but you still benefit when the stock goes up. So, going into earnings, a lot of things to think about and a lot of ways to use even a simple proposition like a covered call to offset your downside risk and still lean bullish, but take advantage of this high volatility environment to sell some options, collect premium, and buffer your downside. Thanks so much for joining us. We're talking about covered calls here every Monday because they're such an important tool for investors to use on their positions. It's one of the most basic option strategies, but it can be incredibly powerful. We're in the heat of earnings season right now, but even a covered call can do a lot, especially given the bid up volatility of earnings stocks. So check us out here every day. Tomorrow we'll be here at 8:35 Central, 9:35 Eastern to talk about collar strategies. You can also check us out on our Twitter at harvested_DAFE because derivatives are for everyone. Thanks so much for joining us, and we'll see you tomorrow.